I'm Teneale.
And I'm Kelsey, and we're financial advisors from 𝐴𝑙𝑚𝑎𝑛 Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast.
Welcome back to Wealth Experience. Today we have a special guest interview, and it is one that I have been very excited and very much looking forward to. We're going to welcome Ben Brinkerhoff. So Ben is a head of advice for Consilium in New Zealand, which is a firm that provides better solutions for financial advice firms, including investment research, model portfolios, and technology solutions. Ben's also responsible for Consilium's partner services and business development and sits on the Consilium Investment Committee. He works with partner firms to grow and develop their ideal life practice. Also, Ben is a frequent author, including his first published book, A Little Book of Financial Wisdom, Clarity. He has over 20 years of experience in financial services, including General Manager of Bradley Nuttall, Chief Operations Officer of Index Funds Advisors LLC in the United States, and in various economic consulting roles in the US and abroad. Ben has his BA in History and Economics from the University of California. He's coming to us all the way from New Zealand, so welcome, Ben.
Thank you, Teneale. It's always a little bit, you listen to your own bio, you're like, is that me?
Did I do all of that?
You did a good job wrapping, 25 years of work experience into 30 seconds. Good job.
Look, I might have cheated. There might be a lot of publicly available data that I've been able to source that from. So, but I'll take it. I'll take the win. So Ben, start off. Our listeners love to get to know our guests in a little more detail. So tell us about you. What do you do in your spare time? What happens outside of the work bio that I just read through?
Oh, so I'm boring, eh? I do three things well. Three things. I do work well, I do family well, and I do my faith well, right? And anything else is just sort of catch as catch can, right? So one of the things I thought, like, what can I share with your listeners that they might not know about me? So this morning I decided that I would count the number of fruit trees that I planted in my yard. Now, I live in the middle of the city. I do not live in the country. I do not have acres of land, whatever people think of New Zealand. Many people do. I don't, right? I just live on a normal city section, whatever you consider that. And I have now 22 fruit trees that I have planted in and around my property. Right?
So hang on, you need to tell us how much space is that in then?
So in 850 square meters. Right?
Oh my goodness, so that's a decent amount of trees.
I have a 4-bedroom house. I have a hot tub. I have a playhouse for my kids. They don't use anymore because they're too big. And I have these 22 fruit trees. And if you think that's obsessive, then you would probably be.
Do you eat all the fruit?
No, I give a lot of it away. And some of it's just like I've only been there for 10 or 15 years. So I'm just sort of like some stuff's still growing up. But like there's just something about a fruit tree that is just so analogous to what I do for work, that you can't just help but to see the connection, right? I'll tell you a story. Maybe you'll find this interesting. So I was thinking about buying a particular type of apple tree because my wife likes apples, but she likes a specific kind of apple called a rose apple.
Yeah, and there's so many of them.
Yeah. So I was thinking about buying this rose apple tree, and which I end up buying. And I went to the orchardist and I said, hey, I'm looking at this tree. When's the right time to plant this tree? And he said, oh, actually now's the right time to plant the tree. And I thought, yeah, I don't know if I'm ready. I'm still going to do some landscaping. And, I came back about 6 months later. So maybe like the exact opposite calendar wise to when I was there before. There's the rose apple tree, not the same one, but they still had them in stock. And I said, oh, when's the right time to plant this tree? Right. And he said, oh, about now. And I said, wait a minute, hold on. You told me 6 months ago that now is the right time to plant the tree. He said, you know what? He said, Ben, I don't know if he called me by name, but let's just pretend he did. He said, you know the right time is to plant a tree? And I said, what? He said, 5 years ago.
Mm.
And I think so often people think about when is the right time to invest. Do you know what the right time to invest was? 5 years ago, right? Because you would definitely be up relative to then till now. And I remember that story. I never actually wrote it into an article. When's the right time to invest? And we get so angsty about when this right time to invest is. We're like, if we had just invested 5 years ago, would we have cared if it was the beginning of 2019 or the middle of 2019? Like, do we even with January or June? Like, no one cares now. You're way up. You're
Absolutely.
way up, right? So anyways, I just think the idea of planting a tree, you pay a bit of a cost, then you nurture it, you water it, you fertilize it, and then pretty soon you have more than enough fruit that it pays for itself every single year,
Absolutely. Absolutely. When you first said that, I thought, this sounds like somebody who's been working with Scott Allman, because I remember one of Scott Allman's clients saying, there was a story that Scott told me way back when we started investing about a tree, and it is very analogous to what we do in work, because the tree story was about, you plant a tree and then it's like an investment. So the tree grows and it bears fruit, and then you can harvest that fruit from it, and you can use that fruit to nourish yourself, but you don't have to cut the whole tree down because you want it to continue bearing fruit for you, bearing the growth and the income returns, right? So it has many places that we can apply this.
I think that, whereas like I also grow vegetables for my sins, and they're not nearly the risk return payoff.
You spent your $25 and you watered your tomatoes, and you got four tomatoes from them, and then they died.
You got to plant another one, right? So no, I definitely prefer the trees.
Well, thank you for sharing a little bit about your trees. I mean, it's better than what happens in my gardens. I don't have fruit trees, but I do have these things called lily pillies, and apparently the little purple fruits on them are edible. I'm just too scared to try it. If I don't turn up tomorrow because I've got a sick stomach, it's because I went home and tried these little fruits. But you talk a little bit about investing, and obviously a big part of your world is building really robust investment vehicles centered around your investment philosophy. And at Consilium, I know that the foundations of your investment philosophy are very similar to what we talk about a lot here at 𝐴𝑙𝑚𝑎𝑛 Partners.
Yeah.
Now, for our listeners, we all those common keys to investing, things like making sure that you've got diversified portfolio, you're not speculating, you're giving your money time to work for you, letting markets work the way they're supposed to. And I did mention before we jumped on the podcast this morning that I'd listened to your recent podcast. So I'll do a plug for the interview that you did on New Zealand NZ Everyday Investor, if our listeners are looking for it. The 7-question retirement strategy, which I particularly liked. So centering around that area of investment philosophy, Ben, has that always been your view of the world of investing, or have you always worked with groups that have a synergy like that, or have such a strong conviction?
Yeah, let me share you a story. When I was at University of California, back in the United States, I did take a class on investing. Now, my first job out of school was as an economist, but I took a course on investing. I had a lot of interest in it anyways, and it was taught by the one specialty of my school was econometrics and statistics in their application to economics, which, by the way, stood me in very good grounds in understanding investing, because there's a lot of things in investing that are unpredictable and random, and there's certain things that are signal. And discerning the difference between signal and random is what you use these tools, mathematical tools, to do. Anyway, so I took this course, and the guy started off by saying, the professor, I'm going to teach you 2 ways of thinking about investing. One is called active and one is called passive. We didn't really know what those things meant. He's like, just throw the record, I'm on the passive side, but I'm going to teach you both. So he did teach us both. But given my background and understanding econometrics and understanding how I discern the difference between what is called alpha and beta, which are returns for risk and returns that are above or below what you'd get for risk. And that I had all these tools necessary to understand and discern what was really real. So I remember when I started investing, which is almost right away after I graduated, we have these things in the United States called IRA accounts. And it's a way you can save tax deferred, and also a saving to a 401k account. And so I called up my dad's broker. My dad had a broker. At the time, the broker said A.G. Edwards. That became Wachovia, which became Wells Fargo, which I don't even know what it is now. And anyways, so I called my dad's broker and I wanted some suggestions on my 401k. And he's like, I was going to invest my IRA with him. He's like, well, what do you want to invest in? And I said, well, I think I'm a passive guy. Can I just have the S&P 500, right? And he ended up putting me, Teneale, in, and I didn't really understand this at the time because I didn't know what A shares, B shares, and C shares are. And your Australian listeners may not know, but those are different classes of shares you can buy. And there are different ways an advisor is paid. He put me in these shares that paid him an upfront commission of 5%. And it was on an S&P 500 fund with ongoing fees of something like 80 or 90 basis points. And those of you that listen to Teneale a lot would understand that's a lot to pay for an index fund. And that is a fairly large commission to pay anyway. But I didn't know any better, right, at the time. And when I actually started to pay attention to what I was doing, so what happened in the interim, I invested that way for several years in a row. Again, not paying attention to the details because I was an economist and doing really well in terms of that career. I remember my wife and I were driving one day and we saw a book liquidation sale. And my wife loves books. You know, some people want to visit the library, but my wife wants to be the library. And so a book liquidation sale is like all her Christmases are coming at once, right? So of course, we walk into the book and it's so prototypical. She goes immediately to the self-help section, right? Which, by the way, she wouldn't visit today if she went to the bookstore, but at the time. And then I went to the personal finance section, right? And I found a book called Robbing You Blind by Mark Dempsey, Robbing You Blind by Mark. And it was a little bit of an expose on the managed fund industry in the United States and how it operated. And it talked about A shares, B shares, C shares, and how the commission structure of how people got paid. And for the first time I read this book going like, this is what's happening to me. I'm paying a commission. And, oh, by the way, I'm paying commission, which might be justifiable for a bit of advice, but I told him what I wanted to invest in. And beyond that, right, the fund he put me in is way, way too expensive for what I'm getting. And I got angry, Teneale, and I shifted all my money to Vanguard. And I'm like, I have to find a better way of doing this. Now, so then what happened is I ended up going on to Google and I just said, I need to find I knew I needed financial advice. People sometimes correlate financial advice with investment selections. I was wise enough to know that there's many complexities in my life and I was not in a position to see all my own blind spots and to know that I was optimizing my own decisions. I needed and I wanted that counsel. But I also know my parents needed the same. I need to get my parents away from this broker. And so I need to find an advisor that recommends this book, because if they recommend the book, they're not doing what the book's doing. So I'm like, I said, you know, almost like advisor recommending this book or whatever. So I came to a website from a firm called Index Funds Advisors in Irvine, California. And he had a book. At IFA.com, he had a book, and it's still in print. It's called The 12-Step Program for Active Investors. and I read it like it was like I consumed this book. I couldn't put it down, because what was happening is they took all these principles that I learned at university about statistics and the appropriate use of econometrics to understand the world of investment and to understand what is signal and what is noise, what is actually value adding and what is just something that is not replicatable. It could look like a pattern, but really there's no pattern there. And it was the application of these things in creating great portfolios. And I don't know if anyone's familiar with like the Alcoholics Anonymous 12-step program, but the second step of that program is you kind of find a higher power. And this book's higher power was called Nobel laureates. And the book went through all the Nobel laureates that had contributed to the field of financial economics. Now, not every Nobel laureate that's their field, but there's several Nobel laureates that is their field. And it went through all of them from Paul Samuelson to Harry Markowitz to Bill Sharp to Eugene Fama. It went through all these Nobel laureates and said, what did they contribute to the field of financial economics? And then how do you apply that? And it was like someone was strumming my heart, right? It was like this my economics brain and then my personal finance brain were just like, now they're totally in harmony. And so what I did is I fired Vanguard and went, this guy's got to be my advisor, right? And I ended up eventually calling the guy who wrote the book and said, what does a guy like me got to do to get a job at a firm like yours? And he's, he wanted to know my background. He liked the idea I was an economist and I could understand these concepts from multiple perspectives. He ended up giving me a job. My title was assistant to the president. I said, what does that mean? He said, it means you do whatever I tell you. Oh, okay, right. All right, I can do that. And but when you throw yourself in, and you'd know this, Teneale, because this was your experience as you've told me at 𝐲𝑚a Partners. When you love where you're at and you love what you do, you accelerate quickly. And before long, a couple of years later, I was chief operating officer at this firm. We had a couple $1 billion of assets under management. I think they have I think they've tripled since I've left. So they've done a lot better since I left.
You're not saying that's attributable to that, though, right?
No, maybe not because I left. Maybe, like, you have to ask them, right? But I loved it. But my wife's a Kiwi, so we ended up in New Zealand, and here we are. So that's been my journey of how I got to this place. So I guess I've always been on this evidence-based approach to investing. I just haven't always implemented it well.
And what I love about that is you're sharing your experience of having a lived experience when it comes to the philosophy that's behind what we do, unless we've had a lived experience one way or the other, or both ways, really. It's a lot easier to explain to our clients and with conviction exactly why it is that we do what we do, right? So I think that's very powerful. And I know that as part of our podcasts before, we've spoken, when we talk about those key principles when it comes to investing, one of the hardest things that there is to manage can be the emotion that investors place alongside it, because when it's my own money, it is a different story. You sort of mentioned there, when the stockbroker puts you into something that you were paying high costs involved with it, that can get you, that makes you angry. That's one key, is that our emotion has this ability to sometimes help us in situations like that, because you go, well, now I'm angry about it, I have to do something, I've got to make a decision. Sometimes, unfortunately, our emotions can play havoc on our investment decision making too, right? Because
were you advising, Teneale, in 2009, 2008 with
It's funny that you say that, because in 2000, I started with 𝐲𝑚 Partners in 2008, at the end of 2008, and I had been with a stockbroker previously that may be redundant, and a firm that had active management as their philosophy before that. So my first job in financial planning was with a group that had active fund management, and they made most of their staff redundant during that year also. So there was a lot of turmoil. I did also have a job offer with Storm Financial a few months before that all happened as well too. So you can imagine me sitting in 𝐴𝑙𝑚𝑎𝑛 Partners office, and at the stage, I started as a receptionist and seeing what was happening out there, and going, oh my goodness, I feel like I've landed in the right spot, because the rest of the financial world seemed like it was crashing and burning around me, and yet 𝐴𝑙𝑚𝑎𝑛 Partners had a steadfast approach to keep their clients on the right frame, on the right path. Yeah.
And that's visceral, isn't it? Like, you feel that. You could feel the difference in the calm of this approach. I remember, for our high growth portfolios, I was managing about 400 million of assets of individual clients at that time, in combination with the founding CEO of the firm. They were his clients, but at the same time, he just said, listen, if clients call up, I want you to speak to them, and I want you to be the first person they speak to. And the States, when prices go down, you do this thing called tax loss harvesting, which means you try to capture a tax loss that you can use to offset gains into the future, because you can carry it forward. And that's a little bit technical, but what it means is that when prices go down, you have a reason to call clients in order to reduce taxes. And we had a client, as prices go down, I call it when there's 20% down, and I'd call them again was like 35% down. I called them again at 55% down. And I remember like calling this client for like the third time, going, let's harvest more tax, right? And I remember he saying to me, Ben, this GFC, it's like having a divorce, but I have to keep my wife. Because his portfolio was down 50%, right? And of course, you get divorced, 50% of your wealth goes. It's like having a divorce, but I have to keep my wife. And it was hilarious, if not sad. And I remember when my portfolio was down 55%, but I didn't really have that reaction negativity. It was a little bit odd. I knew it was the sale of the century. And I was thinking, but at the time, I had a young family, and my wife had paused working so she could have our first child, and of course, there's no raises on the environment, because we're in an environment where our fees were quite down, so like you just had to make do. I remember my sister contacted me because her 401k was down about 50% or thereabouts, and all of her colleagues are telling her, Tab, stop putting money into your 401k. It's just you're throwing it away. I remember saying to her, I said, Tab, how much money are you putting in? And she said, this much. And I said, can you put in any more? Right? And like, they're telling her to stop putting money in. It's just throwing it down the drain. I'm like, no. Like how much? I actually checked in 12 months later from that phone call. My sister's portfolio was up like 40 or 50% from that point.
Did she take your suggestion?
She took
to
my
put in
advice. Thank you.
Yeah.
And she took my advice. She didn't stop putting money in. But the common knowledge was, this is just a waste. What are you doing? It's crazy. And yet they're on the precipice of what would become a 40% return in 12 months. You know, and I know how rare that is. Those things happen a few times in your life. Really, you're going to get that environment, and people were not putting money in, right? What you begin to realize over time is, as much as you and I like to wonk out about optimal portfolios, if you get that stuff wrong, just stuff it, forget about it. A great portfolio might get you 1% more, maybe 1.5% more if you do it really well, right? On expectation. But a bad decision can blow 10, 20, 30% like that. So what's really valuable, right? What's really valuable is that my sister has someone like me to contact and say, should I or shouldn't I? And goes, Ben, if you think I should, then I will. Not even because I understand it, just because I feel good because you feel good, right? And that it really crystallized for me that that's where the value sat. That this is a behavioral question with an economic overlay. rather than an economic question with a behavioral side bit, right? If you behave well, but you're in an average mutual fund, you'll have a great result. Now, if you behave well and you have a great mutual fund, then it's all good, right? But the behavior is at the center of value. And at the center of that is having an advisor who truly knows you and can relate your decisions to your portfolio, to what you really care about, so that it makes sense and so that all the ingredients of trust are there and are honored.
And I love that you talk to talk to trust, because it is a huge it's a huge trust relationship working with a financial advisor, because as you say, who else do you really open up and say, this is everything that I've got, this is everything that you need to know about me personally, my family dynamic, my health, my wishes, my desires, my money situation, the dollars in the bank, all of that. And so being able to trust in somebody to give you that right advice and to steer the ship when the waters are rough is so important. Unfortunately for many people, when they're starting on that journey, maybe they haven't seen a financial advisor before and they're not sure who to trust in, and they don't really understand what we do a lot of the time, right? So they don't understand what a financial advisor's role is, and that it's not all just about investing. Like, we're talking a lot today about investing. It's not all about investing. So oftentimes what we find is, I'll get somebody that walks in and wants to talk about returns. I want to talk about returns in a portfolio now. What type of return can you give me? Can you beat the returns I've currently got? Maybe you can talk a little bit, Ben, about what should somebody expect with returns? Is there such thing as a good level of return? And what do you say to somebody when they are really focused in that space?
Can I just use your analogy?
Absolutely.
So you talk about steering the ship. Okay, so here's the thing, right? Let's just say someone is leaving Port McKay and they're going to Honolulu, right? And that's mainly north, but it's a little bit east, right? And let's just say that you point the boat right at Honolulu the first day, right? It's like, this thing is right on track for Honolulu, right? How many days in the journey till the nose of the boat's not actually pointed anymore towards Honolulu? Right? Within hours, minutes, maybe, I don't know. Like, it's not, the wind and the tides and storms are going to roll around the Pacific, and you're going to get off course. And what a good captain does is they every day they take a bearing. Am I or am I not on course to reach that port? Now, at no point are they ever perfectly on course. But if every single day the captain points the nose towards Honolulu every day, then they're going to get there, right? No matter what storms blow them this way or that way, or the tides push or the winds pull, they're going to get to their course. And what a good advisor is doing is they're figuring out where you want to go. And I would say most people have no idea. And when they ask you a question like about returns, Teneale, what they're really saying is, I think I'm going to be safer, and I think I'm going to achieve what I want better if I get better returns. So you're giving me your solution, which is higher returns make your life better. But I don't actually know what you're aiming for. And I can't captain a boat without a destination, because I don't know where to point the tiller, right? So let's put that aside. Maybe higher returns are exactly what you need. But let's first verify what it is that you're aiming for. Where are you going? Because I can't captain a ship without a destination. And the terrifying thing is, people don't know. It's terrifying, Teneale, when people actually ask you some of those existential questions, like, what do you want to do with your money, right? Design a life in which you really enjoy. What does it involve? Who's involved? Who's there? Where are you going? Who are you around? What are you seeing? What are you doing with your time? A good advisor can have those sorts of tender conversations safely. They take time. They can't be rushed. They have to be done within the context of respect. People are different, and no one needs Teneale or Ben's judgment on their values. If my values are different, they don't need my judgment on their values. They need to understand that I can respect their values. And now that conversation, by the way, can take hours. And especially when you have two people, sometimes they're afraid to have it because they're afraid their partner doesn't necessarily always agree. Because life is full of choices. And if I make this choice, maybe that financially sets me back, but my life is better. And so with that conversation in hand, you actually know where someone wants to go. Now you're just trying to say, okay, well, what kind of boat do I need to get to my destination? And here's the thing. If there's two boats leaving Mackay Harbor, and one of them's like a barge, it's full of sugar, right? And one of them is like, I'm trying to be as like culturally specific as I can. I don't know.
You're doing really well,
right?
It's great.
And the other one's a speedboat, right? Going out to the Whitsundays or whatever it is, right? The thing is, those two ships are different because they're intended for different purposes. And if the storms are hitting, I'd much rather be in the barge, right? In the big boat. It's meant to weather those kind of storms. You don't take trips to the Whitsundays in bad weather. And sometimes you're on your boat and you see someone zipping by and you're like, why am I not on that boat? Look how fast that boat's going. And you're like, but that boat's not intended to go to your destination. So who cares if someone else is in a boat going faster? The point is, will your boat get to your destination on time for what you want to achieve? And we have this jealousy complex of looking at other people's returns because we're not anchored in where we want to go. And if I show you a solution that's the perfect for where you want to go, and I say I'm going to captain the ship, and things go better than expected, I'll help you make wise decisions. And things go worse than expected, I'll help you make wise decisions. And you're in the perfect boat for the journey, because this is a long journey, right? And we need a plan for all weather, right? And if I knew it was going to only be, imagine, Teneale, you knew it was only going to be perfectly good weather. Well, you'd pick a certain type of boat, wouldn't you?
Absolutely. You're on the speedboat then, aren't you?
But we're on a 30-year, 20-year journey. You got to plan for all weather, right? And that's a very different. And sometimes you're going to see boats zipping by you. They're only planning on good weather, right? And if there's good weather, they win. Who cares, right? Will you get to where you want to be in time and in comfort? And do you have a captain to make the journey pleasant? And that is essentially what a good advisor is doing. And that has to start with this conversation where they totally understand where you want to go. And it's a difficult one, but if it's done tenderly and sensitively and with respect, and the advisor shuts up and lets the client speak, which is very hard for us, isn't it? Right? Especially for me. Then now you can say, like, okay, now how do we create a solution which is fit for purpose for that objective? And then people are not worried about someone else's returns nearly as much, right? Someone's got a better return than you. Yep. Their destination's different. So what does that matter? Right? That's no concern of ours, right? Are you on track to achieve what you want in the time frame now? And let's say you weren't. Then I got to make a wise decision. And you're like, well, what's a wise decision? What do you mean by the word wise? Well, if a plan's not on track because of market performance, there are several things you could do, right? You could save more. You could plan to spend less. You could plan to work longer. You could plan to give less away to others and consume more of your portfolio for yourself. You could rebalance into a portfolio that's more likely to grow faster than the one you're in now. All those things you could do. Now, what you got to do, Teneale, is you got to translate those choices into their values. So let's say they give you a value that suggests that what they really want is financial freedom to spend time with family. Well, you're probably not going to suggest the work longer, are you? Right? But not because working longer is the bad decision. It just doesn't translate with their values, right? But you talk to someone else who who's saying, Teneale, you ask them, well, when do you want to be financially independent? And they're like, I don't even know. 60, but I love my job, and then they're in their mid 50s and markets have not performed very well. And they're like, and you're going to them and you're like, you still loving the job? You're like, yeah, I actually love it. You're like, are you really wedded to that 60? No, I'm not. Right. Like, well, if we plan to 62, it's all good. And they're like, fine. It's like it just water up a duck's back. They don't even care. And so the wisdom for one is different than wisdom for another. And your job is to translate what their love and their passions and their values into wise decisions so that they can get back on course in a way that feels as comfortable and natural and inobtrusive as possible. And it doesn't matter to you. All the math works out the same. You know this either way. So that's where the captain needs to know who's on board and what they're comfortable with. And it's that translation of wisdom to what are inevitably going to be markets that go up and down, good sequences, bad sequences, etc. The translation of wisdom into that situation is so valuable, especially if it brings peace of mind. They don't have to think through the implications of that. They don't have to think, is it 1 year extra work, 18 months? What is it? You've done that, right? And you can give them accurate guidance.
It's brilliant. I love that you've taken the analogy of the boat and made it so much better and so much more eloquent as well too. And it's very translatable to a lot of what we do in building a good financial plan. Because as you say, if I'm on the barge and I see the speedboat going past now, and I jump out. So I jump out of the boat and I jump over to the speedboat and go, this is great. And then what's up ahead, this massive storm that nobody saw, and I'm regretting my decisions. Then I've got to jump back out of this boat and hope that I can catch back up to the barge. And you're right. So that those can be those times where we start jumping between investments, jumping between strategies, and making some really bad decisions. They might be good for a time, but they can also be really bad.
Want to invest your hard-earned money but don't know where to start? 𝐴𝑙𝑚𝑎𝑛 Partners True Wealth presents AP Direct Invest, your online self-directed investment solution. Choose from 6 low-cost exchange-traded fund portfolios, including 2 socially responsible options. To manage your own investment experience, visit 𝐼𝐿𝑚𝑎𝑛.com.au/AP Direct Invest and start your investment journey today. AP Direct Invest, your investment solution. Any financial product advice is general advice only and may not be appropriate for you. Always read the PDS.
And behaviours you spoke to earlier, as we've been talking through our podcast today, you spoke a little earlier about behaviours and that being a real driver of our decisions. The behaviours that we're tending to show. So when you see good investment experiences, what type of behaviours do investors have to have a good investment experience, in your opinion, Ben?
Yeah, it's a good question, right? Good investors make choices that are not programmed by what they read in the news or what they're looking to online. They tend not to pay very close attention to financial media, who are trying to create the conditions where they get eyeballs. And they get eyeballs on the basis of threats. People are very attuned to look for threats, and we're all programmed to watch out for them. And so good investors are the ones who say, well, if Teneale said I need to save this much, and if Teneale said I'm on track, then I'm just going to continue doing that until the point where she says you're not on track. And the thing is, you're going to tell someone they're not on track under a couple of different circumstances. First circumstance is they saved less than they told you they'd save, or they've had less financial good fortune than they were planning on having. Or secondly, you're going to tell them they're not on track because their plans have changed. They suddenly need to spend more or spend sooner than they thought they would. The third reason you're going to tell them they're not on track is because market performance has turned worse than expected, and that can happen. If market performance turns worse than expected, you have several options in front of you. Now, the option that people go for is counterproductive. Markets have not done very well. They think to themselves, I want to take less risk. But you and I know a secret, not so much of a secret, but it seems like a secret, that if markets are down and then suddenly you take a portfolio that is able to achieve a certain amount of growth and you move to a portfolio like cash or something like this that has much lower growth ability, then your ability to achieve your objectives craters, right? So a good investor is one that's actually willing to say, oh, gee, markets are down. Okay, well, maybe I need to take more investment risk. Why? And that seems so stupid. Why would I take more investment volatility when I'm down? Because I need it to achieve my objectives, because my objective is more important to me, because it's coming to me over the course of decades. It's more important to me than current market conditions. And Teneale, who I trust, has told me, yep, this is an option. We can do this. You're in a balanced portfolio. If we move you to a balanced growth portfolio or something, or to a growth portfolio, then all of a sudden you're back on track. Oh, good, right? How easy was that? Right? So simple. So a good investor is one who's willing almost to be something called counter-cyclical. Markets are down, I save more. Markets are down, I might take a little bit more investment risk. Markets are down, I might work a little bit longer, right? And depending if I'm in accumulation stage or decumulation stage. So let's say I'm in decumulation stage. Well, markets are down, right? So that's why Teneale has recommended I have bonds and cash in my portfolio, because we knew markets going down was definitely possible. If you knew for sure, Teneale, if you had some crystal ball that said you were only going to have good markets, and you actually knew that for certainty, this is all this pretend world, you wouldn't actually put people in cash and bonds. They would be 100% in shares. The only rational reason you have them in any assets that are not high growth is because you knew ahead of time there were going to be these periods, and I need to ballast my portfolio with something that did better during bad times. So you've planned on down. That's the reason they're in a portfolio that has bonds and shares. And so good investors during these bad times are willing to consume down those assets, because those assets are in your portfolio for the purpose of these bad times. And it's in those times you want to spend them. That's why they're there. And then in good times, you can buy them back. We call this rebalancing. But really what you're doing is you're spending down your stable assets during bad times, and you buy them back during good times, right? And good investors don't worry about that. They're very happy to do. In fact, they don't even think about it. You're taking withdrawal from portfolio, and you're smart enough to take the withdrawal from the part of the portfolio that's up, right? And they allow you to do that and guide them to keep them on track. These are some of the behaviors that go along with good investors. I haven't seen too many good investors that watch cable news shows about investing, and that read magazines on finance. These seem to be the behaviors of people that have a difficult time.
Absolutely. Well, hopefully good investors are listening to podcasts like the one that we're on right now. Hey, Ben.
I hope so.
Well, that's very helpful. I think in reading parts of your book as well too, you did quote in your book that you don't change long-term plans due to short-term noise. So talking a bit about noise right now. That
sounds like something I'd say.
Yeah. It sounded like a good quote. We better throw it in here. Yeah. Because it's, very articulate in this area. I thought maybe you can explain that a little more to our listeners, particularly navigating through times where there is a lot of noise, and how to get through periods like this. If listeners are taking this podcast as much live as they can, they will be going through a period where there is a lot of noise out there in the media and a lot that's happening in markets. So do you want to talk a little bit to that, Ben?
Yeah. So here's the thing, right? It's helpful to know if I'm talking to buyers or sellers, but for the moment, I'm going to assume I'm talking to buyers. people that are putting money regularly away every paycheck into Australian super. If you are doing that and markets go down, you should be rubbing your hands together going, and you know that evil laugh. I don't know if I can do the evil Disney laugh, but it goes a little bit like that, right? Right? Because essentially you're buying at lower prices. Now, we have a store in New Zealand that there seems like there's a sale on every week. It's called Briscoe's. Is there an equivalent store in Queensland?
I guess I'm not sure about sales so much, but I guess you could say Kmart would be our equivalent. Yeah.
Okay, Kmart. So there's generally a sale at Kmart every holiday, and sometimes even for reasons that aren't holidays, right? They seem to have a sale. Now, no one walks into Kmart, Teneale, and says, and they go in looking for socks, and they think, oh darn, there's a sale on socks. I was hoping to pay full price, right? What a shame. No, if you're a buyer, you like low prices. Does that make sense? Right?
Absolutely.
So now, if you are investing every single paycheck into your Australian super and prices are low, you should be happy, right? Because now you shouldn't be happy if you're a seller. So let me just talk now to the side of your clients that are in their retirement and consuming. How many clients do you have, Teneale, that are in full drawdown of their portfolios, so they're living their ideal life, that are in 100% growth portfolios?
0.
Okay. So the reason that you have 0 is because you're competent, right? I'm glad you said 0 because I would know what I was going to do if you said, well, after 14. So they have assets in their portfolio that you can draw on that don't experience the kind of market fluctuation. In fact, bonds are up this year, 2025. Shares are down, but bonds are up. So that part of your portfolio is done exactly what you wanted it to do. That's why you own it. And guess what? When you're taking withdrawals right now, you're taking in withdrawals predominantly from the part of the portfolio that's up, right? And bringing it back into balance thereby. So for those clients, you just have to realize that Almond Partners and smart advisors like Almond Partners are not selling the stuff that's down, right? We're selling the stuff that's up. That's why you have that in your portfolio. So in either case, we've created an asset allocation that's suitable to your need, right? Now, Neil, you must have some clients that are in the accumulation part of their portfolio that are in all equity portfolios. Is that correct?
Yeah, absolutely.
Absolutely. Why? And because if markets go down, they're just buying more shares at low prices. So the fact that they're consuming is a little bit of a ballast in itself, right? So if they're insulated against down markets because of that. So asset allocation and the structure of that has been an amazing tool that you use to give people better results. There's a science behind how you allocate and why at certain ages you're in certain allocations, right? And it's not difficult to know it. It's just shocking to me how often it's contradicted. You see people that are accumulating in portfolios and they're in defensive or conservative portfolios. Why in the world are they in defensive, conservative? Oh, because they took a test that said, would you feel uncomfortable if you had a 20% loss in markets? I don't know if you give people those tests, Teneale, and don't answer because in case you do, right? But I hate those things. We have a test that says something like that advisors use, and I hate ours because it doesn't convey this simple truth that says you may feel uncomfortable, and that would be very, very normal. But you have an advisor, and your advisor knows what to do, understood these markets could happen, and knows that we're directing your ongoing contributions into these low-priced assets, and that over the long run, because you have a very long time horizon, you're still accumulating, you're going to be better off as a result of it. And if you're ever troubled, I'm here, right? So That's never part of the survey. I've never seen this questionnaire that says, are you uncomfortable after a 20% loss? But because your advisor's there, you're willing, I'm saying that's never part of it. That's just such an important piece of the story. So you see this simple, or I've actually seen people in retirement drawdown that are 100% in shares. But why? Because if they're drawing on their portfolio, and if they're drawing on their portfolio, then they're really exposed in that situation. If things go badly, they have a double whammy of things going badly, plus they're selling the things that have gone badly. I suppose if you have so much money it doesn't matter, then who cares, right? But in that world, you're really not trying to spend down your wealth to live an ideal life anyway. So I guess it's a different subject or question altogether. So these are some of the things that advisors look at and do to create the conditions where even in the midst of markets like we're having now in the first 3 months of 2025, where you can have a long-term focus, right? Don't ruin a long-term investment solution with short-term noise.
I love that. You brought it right back to the very first quote that I started the question with. So kudos. But it's very topical that you say, when you're in drawdown phase, particularly too for our Australian listeners, whilst superannuation in Australia is one of the biggest assets, obviously supporting retirement funding, and whilst most that are in industry super funds, we call them, Ben, they probably don't have even 100% in growth assets. They might have, on average, about 70% in growth assets if they haven't made an election of what to do with their superannuation monies. But one thing that we do find is, in lieu of receipt of advice, many people have retired with industry super funds that have a pool of assets. So they're even if they have 70% growth assets and 30% defensive, the pool effect there means that if they need to draw from their portfolio, they have to draw 70% from growth and 30% from defensive, regardless of the market conditions. So that's an interesting dynamic that we have here, because that in and of itself has forced many people with industry super funds to have to go back to work when they go through uncomfortable periods of markets and have to draw from those assets that are down. So it's very interesting that you bring that up.
In the United States, we have this really, you've told me one of your Australia's sort of bad solutions. In the States, we have these things called glide path funds. And what happens is they automatically take less and less and less equity risk as you age. And they are a menace. And they're very, very popular because they feel like they're a set it, forget it solution. And here's the thing, right? If you run into the early part of your retirement years, if you run into a market that is very unfavorable, and in the midst of being in that unfavorable market, you are decreasing the amount you have in shares, you are taking away one of the truly helpful functions you have to get back on track. So you're double whammying. I'm basically withdrawing, and I'm basically taking that from shares while shares are down because I'm glide pathing down anyway. And the result of that is I've increased the chances that I really run into trouble if I have longevity. They are a menace, these schemes, and advisors that are thinking don't put their clients into them. But not all advisors are of the same quality, of course, right? So there's some science and there's some thought that goes into these things, even if on the surface of it, it may not seem that much.
It's very interesting you say that. We have seen a similar trend in super funds in recent years where they have introduced that glide path approach in the industry funds in Australia too. So for our listeners,
it's a bad idea in the United States, and now Australia is copying it. Please don't copy all United States bad ideas.
It would appear that way, yeah. Okay, so for our listeners that are maybe thinking about investing, perhaps they haven't, one of the questions that we do come across quite a bit is, for new investors, is Should I be putting all of my money in today? I know if we take it back to your story about when's best time to plant a tree, it was 5 years ago, but perhaps I didn't plant the tree 5 years ago and I've got the money in the bank account now. I'm ready to do something with it. Should I be putting it all in now, or hang on a second, I saw that markets are going down because of everything that's happening out there in the world, and maybe I should be drip feeding it in to my portfolio?
Well, you said the wrong, you're kind of quoting a client there. Markets are going down, but Teneale, markets are never going down. You don't know where they're going, right? You just know they've gone, right? So, clients will tell you that. They'll say, oh, markets are going down, Teneale. And you almost have to stop them. I know it sounds bullshit. You got to stop and say, stop. Markets have gone down. You don't know where they're going. So when you are in a framework, because listen, logically, if they're going down and you have some certainty about that, then by all means, wait. Right? But how dangerous is that, right? They've gone down. So the math is this. Between 60% and 70% of the time, if you go in all at once, you're better off. I kind of liken it to a surgeon coming to me and saying, listen, to fix what's going on with this thing you have, there's two surgical approaches we could take. They're equally as painful, but one of them has a 70% chance of success, and one of them has a 30% chance of success. Which would you prefer, right? Now, I don't think a surgeon would ever ask that question, because they would take the question, they would take it out of your hands, and they would only present the 70% chance of success. But advisors are like the surgeons saying, here, we could do it two ways. One is a 30% chance of success. One is a 70% or 66% or 6% chance of success. Use your number. Which do you prefer? Now, here's the issue, right? If I say to clients this, let me just try this on you. I say, listen, let's say they're a little bit insistent. Yes, but if they do go down from here, I would just have so much regret. So I'd like to stage it in over time. And I say, okay, so what I'm doing is you're paying a premium for regret management. Okay. And that's fine. People do. They pay premiums for regret management, right? So I get that. Okay. So then here's the thing. If markets go down from here, what I do not want you to tell me is, oh, they've gone down, I'm going to wait longer. If they go down from here, you have got to put the money in. In fact, if they go down from here, I want you to do two things. I want you to put the money in, and I want you to buy a bottle of champagne, because you just flipped a weighted coin that was weighted heads, bet on tails, and you got tails, right? So you were likely to lose. You won. So you got to feel happy about that. But here's my experience. Markets go down further. You think, oh gosh, I prognosticated this thing once correctly. I'm going to do it again. And you don't put the money in, even when you won the weighted coin flip. So you don't buy yourself the bottle of champagne. You haven't said, I've won the game, right? You prognosticate again and again until eventually you're the loser. Okay? That's what happens. So here's our deal. If you are going to delay and markets go down, you have to email me how happy you are. You've got to say, I am thrilled to pieces. I won the game, and you better put every dollar in. Are you willing to do that?
Are you asking me the question now?
I'm pausing for dramatic effect.
I was like, gee whiz, I think I'm ready to invest my money.
So, but you see, I'm being a little bit over the top, and that's okay. Just a little bit for drama. But the point is, I'm going to put that in front of them. I'm going to imagine the world. I'm going to tell you you're likely to lose. And then I'm going to imagine the world where you won. And are you going to be one of those people that are at the casino, you won a couple hands, and yet you put your original chips on the table and you keep on betting down until you lose, right? Or are you going to buy the person that says, I won on a game I should have lost, I'm going to take my winnings? What's it going to be? So I imagine that circumstance, I put them in it, and I say, you have to tell me that you're going to act the right way, or else, because if you don't, you are only going to lose. We have a game where there's a 70% chance you lose, a 30% chance you win. The 30% chance you win is contingent on you actually put the money in after the loss. But if you're not willing to do that, then guess what you're left with, Teneale? 100% chance you lose. And I'm just not willing you to sign up to a 100% chance you lose proposition. Or else they should take my financial advising badge and they should rip it off me and they should throw it in the waste bin. I'm just not willing to let you do that. So if you're going to play the odds and you want the 30%, then I have to be ensured that you're going to act the way you should if that happens. What do you think?
Well, I definitely think that this has been a brilliant way of also wrapping in some of those traits, some of those behavioral traits that can cause a real menace, because in the face of logic, we can make very sound decisions, or we can let our emotions override, like you say, and make a very bad decision and sit on it and sit on the fence and wait for that period of time. And who knows when the top is and who knows when the bottom is? None of us do. We don't have that crystal ball. So you're absolutely right. And I think today we've been through such really good content that we could go on for ages, and I would happily do so. But what I would like to do is maybe get you to come back on another podcast in future.
Sure.
And we can explore any one of these topics in more detail if you'd be happy to. So,
yeah,
but before we wrap up, I thought, do you want to share if you could give somebody a single piece of wisdom, if looking back over your career, there was one thing that you went, if nobody listened to anything that Ben had to say except for this one thing, I'd be happy. That's a big ask that I've given you right now, but what have you got for me?
Here's the thing, right? Do you know how value and growth go through different phases? And over time, value has higher returns, and there's good theoretical reasons why, but it doesn't happen all the time. And recently with the Mag 7, growth, expensive firms got more expensive is the way I put it, And so value kind of hit a zenith in about 2006 and just before the GFC. And I started investing in 2007, right? And so if I basically timed this thing as badly as possible, right? With my own money. So I've gotten the whole risk tilting thing badly wrong. Now, by the way, I'm very happy, but I just so happened with my timing, by the way. But here's my point. I am completely on track for retirement. And we can talk about things that are of small consequence, value versus growth, small cap versus large cap, etc. But the thing I did is I simply saved what I was able to save and to maximize my employer contributions and maximize my tax deferrals every year from basically when I was 21 till now. And even though I've gotten some small things wrong, I've gotten the big things right. And I am completely on track. Now, would I have been better off if I had been the S&P 500 that whole time, right? Probably not at like 5% sales loads and 90%, yeah, maybe. And it doesn't matter. My boat's still pointed towards Honolulu, right? And I think it's the day of small things that we ought not to despise, right? Which is if you do those things right, they just trump the other stuff. That's probably the wrong word to use these days, Trump, isn't it? It's just so much more important than the other things that it's the behavioral questions. And then this is the idea of during COVID, just investing per normal. During the GFC, investing per normal, right? during the eruptions of 2022, investing per normal, right? That's when I got my best returns. Why would I stop then, right? So these things, we can try to almost optimize around the side, Teneale, and maybe we should, but gee, that's actually a sideshow. If you simply behave the right way, you're going to be on course, and that I've done, and I'm very happy now. I never heard anyone my age look back and say, gee, I really regret I saved in my 20s. What was I thinking? Right? I've never seen someone do that. And I'm certainly not going to do that, because now what happens is it makes all the choices now between 45, I'm 45 now, and into my career are much more in my hands. My choice set is much broader. And that ways I can optimize the last half of my working career without panic to do the things I really enjoy. They might pay well, or maybe they don't pay well, but I can make those choices with confidence, right? So I think that's my bit of advice. I think that was a long-winded. I'll leave it there, but hopefully that hit. You got what I was getting at.
I love it. I think our listeners really would have gotten something out of today's podcast. You're beautifully eloquent at, articulating some of these concepts that, we talk about each and every day, and we can get really excited about them. But I really love that you can translate that into a way that listeners, I think, will truly value too. So thank you very much for being on our podcast today, Ben. We've appreciated you being here. And for our listeners, please don't forget to like, subscribe, and share our content. And if you'd like to hear more from someone great such as Ben, please let us know. We look forward to hearing from you next time on Wealth Experience.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.